Valens Research, Uniform Financial Analytics.
Of course, Moody's the credit rating agency who, whenever you issue debt, you have to either basically pay them or S&P or Fitch in the United States to be able to give a grade on your debt for institutional investors and many others to possibly buy it. And what jumps out to us from Moody's is, right, this company is a basically government mandated oligopoly. They print money because you have to come and buy stuff from them. And it shows through when we look at the return on assets, right? You look at a government mandated monopoly, an oligopoly, you would expect 50% return on assets. You wouldn't expect what the as reported metrics show, which is only a 13% ROI. You'd say, what is Moody's doing that this company is basically a guaranteed cash flow machine and it's only generating a 13% return on assets? They've got no competition. There's only 3 people in the market and all of them have high prices, right? That doesn't make any sense, 13%. The more important thing that doesn't make any sense is when you look at the as reported metrics, you wouldn't think that this company just was a 13% return on assets business. You would think it was 13% and declining. Return on assets on an as reported basis was 18% and is now 13%, right? But if I step back and I think about everything that's going on in the market, more people, right, especially think about in 2019 and into 2020 and all the debt that was issued, more people are actually buying credit ratings right now. We've got more complex things happening with credit every single year. You've got more reasons to need to pay Moody's more. And no surprise, that's why we see return on assets when we see through the accounting noise actually rose. Didn't fall from 18 to 13%. It rose from 40% to 53% over the last 4 years. You'd only know this if you were looking at the right uniform accounting data. And only then would you be able to qualify to say, hey, look, sure, Moody's is trading at a 25 times multiple. But you know what? If I've got a company that has a robust economic that has a robust moat around its business, that has, because it's regulated to be what it is, and also has opportunity for growth as more complexity means more people are buying its stuff, well, you know what? That makes sense. Cash flows are not at any risk and returns couldn't even rise and it could grow. Well, of course, I'm going to be paying a 25% return, which is what the market's basically pricing, that this return on asset improvement is going to continue. That makes sense, as opposed to if you were looking at this using as reported metrics and you'd say, I've got a business with declining returns trading at a 27 times multiple. This is like a screaming short, government subsidy and government guarantee or not. And that's what you'd be missing. You would literally have a directionally wrong opinion on Moody's on if it's good or bad and if it's improving or declining. That changes how you analyze the business and changes how you value the business and changes how you invest. That's the risk with as reported metrics, right? That's the risk of trusting arcane accounting mathematics as opposed to focusing on the world of companies.
Valens Research, the world's leading source for uniform financial analytics.